Hello, everyone, and welcome to another episode of the Chicago Business Review. I am your host, Young Lee. I am a real estate broker here in the Chicagoland area, real estate investor, and serial entrepreneur, and I am so excited for today's guest. He is a 24-year veteran of the mortgage origination business. He is a branch manager at Wintrust Mortgage for over a decade and one of the great advisors when it comes to mortgages and home loans with a client-first approach. And so I'm so excited to ask him questions and bring you guys value in terms of what you can look for when looking for a mortgage. So without further ado, Marty, thanks so much for joining us today. How are you?
Hey, I'm good, Young. Good to see you.
It's great to see you as well. So I know a lot of people have been reading the news and just kind of curious, and I wanted to get your thoughts on the interest rates and what's been going on with that and what you think is going to happen with them moving forward.
Yeah, well, the good news is interest rates are down here in the calendar year of 2023. In the fourth quarter, we experienced the highest rates we've seen in over 20 years. They did start with a 7%, which, as you may have felt, slowed down our house buying or selling process there in the fourth quarter.
Definitely, yeah.
So we are seeing a lot of rates starting in the fives, pushing the 5.875 or hanging at the 6% is probably the average over the past 2 weeks, but still very good comparable to recent histories.
Yeah, no, that's what I keep telling clients and even younger people like my kids. I'm like, when I first came out of college, in the early 2000s when I was looking to buy my first home, we got a 6.5% interest rate, and we were like jumping for joy, being like, amazing, what an amazing rate. And so a lot of it has to do with perspective of recent rates, but we're still, if you look at the chart, fairly historically low. So that's been encouraging. Do you anticipate them rising moving forward, staying stable, going down? What are your thoughts on that?
I think if you were to read 10 different economic forecasts, you probably see 5 economists that say that they're going to trickle up, and you'll see 5 that say they come down. So it's a moving target for sure. It is an objection, or has been an objection in home buying. But what we're finding right now is it's a great time to be purchasing just with the decrease. Going from where they were to where they're at currently, going into the spring market. As far as the year end, I'm going to teeter on a little bit lower. I hope they start with a 4, if not a low 5.
Yeah, that would be incredible. And I know that a lot of things that both you and I advise our clients on are that mortgage rates are going to change, and you can always refinance or look to get a better rate if that does change in your favor moving forward. So definitely don't get scared off. Now, don't overextend yourself at the same time. But if you are in the ability to purchase, right now is as good a time as any to get into buying a home. And so I know one. Oh, yeah.
On that, Young, that is one of the objections we're hearing is just where rates are at. And you segued perfect into my group, or my team, is going to refinance all of our clients that purchase this year for free. So we're going to pick up all the closing costs to remove any kind of objection of we're going to wait for rates to go lower. Primarily because we also feel that there's a major shortage in supply. And when that happens, there's more demand, prices go up. So we want to help everybody that has the financing objection in their mind, take that away, that when and if, I shouldn't say if, when rates come down, we are going to refinance their mortgage for free.
That's incredible. So that's if people buy this year and the rates go down later this year, you will cover their closing costs or the cost to refinance the loan. Is that right?
That is correct. Yeah. So the refinance can happen anytime. It doesn't have to be done this year. If rates fall January 3rd of 2024, we'll do it then. If it's, 2025, we'll do it then. Or if it's in June of this year, we'll do it then.
Wow. No, that's incredible. And another reason why I'm so excited to have a professional like Marty here on the show, because he always is taking into account the client's best interest. And one of the things you do, which I love, is something called a mortgage checkup. Can you kind of elaborate on that and how you do that with your clients?
Yeah, with the mortgage checkup, our goal there is to reach out to our database. Usually do it by the month. So all the January people get calls in January, February, March, et cetera. And the main goal is just to reach out to see if any circumstances have changed, make sure that everything's affordable. If rates are lower, of course, we start talking about refinancing. In that checkup, we also talk about, maybe rates were down a point, but they're very comfortable with their payment. Instead of just doing a 30-year fixed to a 30-year fixed, maybe we shorten the term down to a 15-year and show them that they'll save $120,000 of interest or however much that number is. So it's more of a financial plan. And that becomes really fun when people get excited about looking at it as a financial tool.
No, and I think that's the one misconception in this business is that, all real estate brokers or all mortgage originators are the same, but the person that you work with should be a professional and should be able to save you a significant amount of money over the period of time that you're working together. And that is so different depending on who you get to work with. And one of the reasons why I love working with you, Marty, is that you always take into the client's best interest first. And that's why I love that mortgage checkup that you do. And then I know you've been with Wintrust Mortgage here for over a decade, being the branch manager there in South Barrington. What are some of the programs that you guys offer that you think are unique for your lending institution and that are also beneficial for potential home buyers or investors?
Yeah. So a lot of different options out there. Part of a checkup or a initial consultation is just really understanding the goals of what somebody's looking to do. If they're looking to buy their first home versus their 5th, 6th, 10th home, whether they're looking to invest in a property or tear down the home and build a new home. We've got a large menu. Some of the more recent highlights have been, or misconceptions, I should say, is the number of 20% down payment is needed. You've probably heard that from a buyer before. I can't buy till I have 20% down.
No, that is so true. And I feel like no matter how many times I shout that from the rooftops, it's still something that people think they need. And I know you guys have programs where you can put significantly less than 20% down. What are some of the minimum down payments, I guess, that clients can utilize to purchase maybe their first home or a home?
Pretty standard is anywhere from 3% to 5% down. And then we can couple that with some down payment assistance programs or even seller credits to help pay for closing costs. Depending on the market, it does become very common where we negotiate, $5,000 into the offer to help pay for those closing costs. So yeah, we definitely can do it for way less than 20% down.
Oh, that's really good to know, and something that I work with my clients as well, depending on their situation. If they have a lot of down payment, then maybe we look to get a lower price on the purchase. But if they are a little bit tighter on that budget, but they do want to purchase a home now because they see the benefits of home ownership, we try to work with them in terms of asking for a closing cost credit to help offset some of that money they need to bring to the table. So that's always great advice. Another thing that I know you guys have is a 1-0 buy down program. Can you explain a little bit what that entails and how people can utilize that?
Yeah, you got it. So 1-0 buy down program is comes out. It's an old tool that gets rebranded, remarketed. but it comes out when interest rates start to increase. With rates, to use an average rate of 6% here over the last couple of weeks for easy math, if a 30-year fix today is at 6%, a 1-0 buy down buys down the interest rate for the first 12 months to 5%. If we took an average purchase price in our area, I use $600,000 just as a purchase price. If somebody was putting down 20% was how I ran the numbers. You can do it with that 5% down, the same program. But in this example I ran today, the difference in the principal and interest was $301 difference per month.
Wow.
So again, that means a 5% versus 6%. For the first 12 months, that person would save $3,600 in their monthly payments. Huge benefit there is that we hear, I'm going to wait for interest rates to come down, right? They will, but when? We don't know that answer. So if their life event is happening now that they want or need to move, this is a great program to use to help affordability today to purchase that home.
That's incredible. Now, is there an added cost to enroll in that program, or how does that work?
Yep, it's simple math. That $301 a month totals $36.12 for the year. Again, that's usually negotiated into the sales price. So as we're making an offer, it becomes a seller credit. So the buyer doesn't pay for it. It's paid for by the seller. So this can be used as a unique tool for a buyer or a seller. The seller could use this as a financing promotion on their listing that would differentiate themselves from the market.
Yeah, no, I love that. And that's something that I've been advising my clients who are listing their home for sale is maybe not doing a price reduction, but buying down the buyer's rate to make that home a bit more attractive or a bit more affordable to a larger pool of buyers. So I love that. Something else that you guys have are non-conforming ARMs. Can you elaborate a little bit about that program?
Yep, absolutely. So ARMs, adjustable rate mortgages, they come into play, again, as interest rates tend to go up or go down. But right now it's a hot topic. 30-year fixed. So I used it as a non-conforming loan amount just to give us a different perspective on this one. We had somebody buy, I think it was right at $999.5 or something on Friday. They put down 20%, so the loan amount was right at $800,000. As we were doing the math for these buyers, we compared a 7-year ARM, which is fixed for 7 years, versus a 30-year fixed, which is fixed for 30 years. The 7-year ARM pricing was coming in at 5.375 versus a fixed rate around 6%. On that size loan, on an $800,000 loan, that was a savings of $317 a month. For 12 months, it's $3,804, or over 7 years, that person would save $26,628. So as we give them those options, that's part of understanding what the people's goals are. This client wasn't going to, it was a relocation. They were not going to live in this home for 7 years. So they knew that they would be moving probably by year 5 with another promotion or relocation. In their circumstance, it's a huge financial impact to their monthly budget for their yearly.
Yeah, no, and that's another thing where it's so important to make sure that you're working with a professional like Marty, where they're going to analyze your unique situation, because in this example, that person knows they're not going to be there for longer than 7 years. So why lock in a rate of 30 years at a higher interest rate when you can lock it in for a lower rate based upon the time that you're going to occupy that residence? So I love that. And one of the programs that I really love that you guys offer that is pretty unique to Wintrust is the professionals program. Now, I know some other places have some different variances to this program, but can you share a little bit about that program and how it can be a benefit?
Yeah, absolutely. So the professionals program, it's a unique program to us at Wintrust Mortgage. They have, it's not just, it was originally introduced by some banks to do just for doctors. We found that was kind of targeting or segregating one market or one buyer, one set of buyers. So ours has been expanded to attorneys, any kind of dentists. Sometimes aren't really, I should say, there are different doctors that aren't considered medical doctors. So ours does fit all encompassing. Any MD, PhD, advanced degrees for teachers fall under this program. The major benefits is as you get into that non-conforming market, so loan amount greater than $726,200, we can do 10% down with no mortgage insurance.
So they can put less than 20% down and they still wouldn't have PMI or private mortgage insurance, which tends to be a hefty number when you're looking at loans of that amount. And so that's going to definitely help their buying power in those initial years as well and save them quite a bit of money, I would think.
That's right. You qualify for much more. And again, it could be a couple $100 a month for that mortgage insurance with less than 20% down.
No, that's incredible. And so you were saying doctors, dentists, even PhDs, you were saying?
Yes.
Yeah.
Pharmacists, advanced degrees, teachers with masters or doctorates.
Oh, teachers as well with masters or doctorates. Okay.
Yeah.
Oh, so that's hugely beneficial, and it doesn't just help one group of people, but a wide range of professionals. And so if you are in one of those fields, that might be something that can be very advantageous. But another reason why having a person like Marty in your corner to at least talk to and or explore your options is so critical. So I love that as well, Marty. Now, there are a lot of people that may have some misconceptions about mortgages or buying a home. And I know we kind of debunked one with the not needing 20% down. But what are some other pieces of advice you might give people that are either on the fence or are looking to get their first mortgage and just they don't know what to do or what they should even be planning for or thinking about?
Yeah, great question. With our initial consultations, usually the first phone call we receive from a home, prospective home buyer, the major things we cover is get pre-approved early. There's no issue in getting pre-approved today with buying a home if you're not going to buy a home for 30, 60, 90 days, 6 months from now. The reason we say to get pre-approved is just so that we can plan, but then we can uncover anything that could come up at the last minute as you want to make an offer on a property. Those things would be quite simply, if we pull credit, we can look at credit together. Fannie Mae and Freddie Mac are coming out with a new scoring system on what we call risk price adjusters that about every 20 points in a credit score, the higher your credit score is where you're going to see your best interest rates. Every 20 points lower, there's going to be a little bit less or a little bit higher in price. It doesn't equate to an eighth in interest rate, but the sooner we can get involved, we can make suggestions on paying off that Target card or paying down that credit card that you used for furniture. And as we pay down those balances, credit scores can go up. The higher your credit scores, not only for a mortgage rate, but also for your homeowner's insurance and your car insurance, those premiums will be lower. So get us involved early. We'll make recommendations. We'll work on it together. And then, of course, savings. As we prepare to buy a home, we recommend everybody cuts back on different things they're spending money on just so that they can have more cash available for that new home.
No, that's such good advice. And I think a lot of people are nervous to reach out to a lender because they're like, you know what, we're just kind of starting out. We don't know if we're that serious yet. And then they end up seeing a home that they really like and they start scrambling. And with the low inventory that is out on the market, they tend to miss out on an opportunity that they could have potentially moved forward with because they were hesitant to reach out. So I would strongly also recommend one of the first steps is always reach out to a mortgage professional like Marty and just go over what your options are. Like he said, it doesn't affect you negatively in the long term. And it's such a benefit for you to just know either that you're ready to purchase right now, or if you make these small changes, you might be able to purchase in a month or 2 months, or you might be able to purchase a lot more than you initially thought, but you won't know that until you actually talk with a mortgage professional. So I think that that is extremely helpful. And the advice about making sure you're working on your credit score because of those, that affecting the potential rate that you can get, I think is also very helpful. Now, what amount can people like borrow up to? There is something called a debt to income ratio. Is there a certain percentage that maybe consumers can think about in terms of how much they can afford and such?
Yeah. So most programs will allow you to go up to 43% of your debt to income ratio. That takes into consideration any minimum monthly payments you have on a credit card or a car loan or student loan. The mortgage is also factored into that 43%. And then as people put down more than the minimum down payments, if you get down to or get up to like 20, 25, 30% down, that number definitely can be stretched. We've seen loans approved up to 50%. Some have trickled over that 50% number, but there has to be some pretty unique circumstances to do that.
Gotcha. But 43% is a good, safe number for people to kind of factor in. And another thing that I wanted to mention was that Marty was kind enough to provide us with a mortgage calculator, which we'll have in the show notes. So if you wanted to try and figure out what a mortgage payment might be for a purchase price based upon today's interest rates, you could definitely utilize that tool. And we want to thank Marty for that. Like I said, we'll have that in the show notes for you guys to check out as well. And then just to clarify for people that maybe don't know, the income, it's 43% of their gross income or their net income?
Gross monthly income.
Okay, their gross monthly income. Now, what if they're self-employed? How is that different than maybe a W-2 employee in terms of the mortgage process in general?
Yep. So after all their business write-offs, the amount that they report to the government, we take a 2-year average of that income to qualify for their new loan.
Okay, great. Yeah, because I know a lot of people think like, oh, well, I made this much in revenue, so I can afford X. But a lot of times they're not factoring in all of the write-offs that they've written off. So making sure that they have that balance of income versus write-offs, and something that people should be aware of if you are self-employed or have your own business and things of that nature. So I think that that's extremely helpful. Now, what about like while they are in the process, like they've been approved for the mortgage and they're waiting to close? Is there anything that they should be doing or not doing during that process that you would advise?
Yes, we talk about this all the time. So as you're preparing to buy a home, whether it's before contract or during the sales contract, waiting to close, we highly recommend to not quit your job. Don't buy that Ferrari you've been looking to purchase. Don't make any major purchases that would impact your credit or the amount that you could qualify for. And we will try not to have you transfer funds from too many accounts. That just leads to a paper trail that we've got to document for underwriting. So mainly keep the same employment while you're under contract. If you do change jobs, we understand we're just going to need to redocument that.
No, yeah, because I know when I first got into the business, one of the people that I was helping, they ended up not being able to purchase their home because they did buy a Hummer while they were under contract. And unfortunately, they were not made aware that they shouldn't make any big purchases until maybe after they purchase the home. And of course, we always recommend that you be financially responsible with all of your finances. But definitely during that time when you're trying to get a mortgage, no big purchases is going to be a big thing that both me and Marty would recommend to you.
That's right.
And then I guess we've been talking about just loan programs and things that buyers can do. What are some advice for people that already have a mortgage? I know we kind of touched on it, and then you guys are so generous to offer to refinance. But can you explain a little bit about like refinancing and how that can be a benefit for clients?
Yeah, it comes back to each mortgage really is like a fingerprint, right? Each person's financial situation is totally different. So when we do those checkups, the mortgage checkups, we're really just trying to identify that they're in the right financial position. Different circumstances. Last Friday or 2 weeks ago Friday, we met with a client that their house was paid off. They took out a home equity line of credit to do renovations to their home. Well, as the prime rate has gone up, we identified that the interest rate they were paying was closer to 8% on their home equity line of credit. We were able to refinance their loan down to the mid fives. I think they took a 15-year fix at 5.5%. Payments weren't too far off, and now they're paying down the principal over 15 years as opposed to having that home equity line of credit out there.
Yeah, no, that's amazing again. And so there's so many different options and tools when you do own a home to utilize mortgages or different tools with mortgages to save yourself money over time. Now, I don't know if you guys necessarily work on them, but you just mentioned a HELOC or a home equity line of credit. How can people utilize something like that to their benefit?
Yeah, so home equity line of credit is a second mortgage behind if you have a first mortgage that people can use almost like a credit card. It's an open line. So let's say somebody opened up a line for $50,000. Most times people are using those for home improvements. Sometimes they're using it for debt consolidation, paying off higher interest rate credit cards or student loans. We have had people buy cars with them, and it really comes down to where interest rates are in car loans or credit cards versus what the home equities are. But it's really looking at it as a holistic approach of what's in their best interest. I don't personally do them, but we can make an introduction to a banker at one of our banks to help them with the home equity line of credit. Very easy process. There's no closing costs with the home equity line of credit.
Yeah, and that's a tool that I feel like is very valuable. And another benefit of purchasing a home is that you can utilize the equity that you've built up in your home for debt consolidation or home improvements, or even maybe taking that trip or buying that thing that might have cost you more if you financed it with a higher interest rate. So many benefits of buying a home and having these mortgage tools at your fingertips versus renting and not having any access to these types of things. Marty, I know you've been so generous with your time and answering all of these questions that I had for you. Now, if people wanted to get in touch with you, what are some of the best ways that they can find you? Would it be on LinkedIn, your website? Can you share that?
Sure, absolutely. Website's real easy. It has all my contact information. It's my name, just simply Martin, Martin, Maher, Maher.net. My cell phone, always with me. Feel free to text or call. That's 847-757-5363.
Okay, so we'll have all of that information in our show notes as well so that you guys can reach out to Marty. And if you have any questions, he'd be happy to answer those for you. Is there any fee for people to reach out to you for an initial consultation or anything like that?
Yeah, great question. I was going to bring that up during the pre-approval as well. So no, there's no fees that are charged for our services. You're simply calling, we're talking, we're listening to or identifying what you're looking to do. I'll ask you 5, 10, 15 questions just to uncover various topics. But yeah, there's no fee for a pre-approval. The only time you start having a fee is once you've purchased a home and we're paying to do the appraisal.
Okay, so because you mentioned that, I guess another question that buyers or people looking to buy and utilize a mortgage would be asking are, what might be some upfront costs that they might incur? Now, granted, your service for consultation and a pre-approval there are no charges for, but what are some things that buyers might expect to pay out of pocket before they get to the closing table?
Really, on our end, it's the appraisal. Home inspection would be something that gets done sometimes before they do the application with us. But home inspection, I've even seen them around $500, I would think.
Yep. Yeah. And so that's typically what I tell people is things that you're going to need to kind of budget for before the closing are your earnest money, which is part of your down payment that you're giving as consideration for the contract, a home inspection, which we both would strongly recommend you get done, and then your appraisal that the lender is going to need to make sure that the home or the asset that you're looking to purchase is worth the amount. And that is also for your protection as the buyer so that you know that you're buying a sound asset. But other than that, everything else typically would be expected at closing, correct?
That is correct.
Awesome. No. So, Marty, I think that this was just an incredible amount of value and information. And we always appreciate your advisory type of strategy when working with clients. And that's why I was so excited to have you on the show today. So please, guys, check out Marty's website. It's martinmaher.net, and that will be on the show notes as well as that mortgage calculator. So check that out so you can see roughly what your payments might look like. But please reach out to him before you're looking to purchase a home so he can work with you and get you in the best position to get that home of your dreams when you do identify it with a real estate broker like myself. So thanks, guys, for listening. Marty, thanks so much for your time. I really appreciate it. And thank you guys for listening, watching. And if you found value in this or you know somebody that is looking to get a mortgage in the near future, please share this episode. And we appreciate all of your reviews, and those 5 stars really help us to be able to bring on great guests like Marty to provide this value for you guys. So once again, my name is Young Lee. This is the Chicago Business Review, and we will see you next time. Have a great day.
Thanks, Young.
See you, Marty.